Hello and welcome to this brand new episode of Smart Money. Today we have with us Prableen Bajpai, the founder of FinFix Research. She's a CFA, a certified financial planner, and she's been in the industry for over 15 years. And today the topic of discussion is something that's on everyone's mind, financial planning for millennials in the age group of 26 to 40. Prableen, thanks a lot for joining us on the show. It's very interesting, right? I mean, in the last 1 week, there was this article that went viral about the Mercedes head of marketing saying that people now prefer investing their money more in SIPs and in the market than in buying a luxury car. So that just goes to show that the awareness with respect to equity markets and the equity cult is definitely growing. But you tell us, how does one go about it in their early 30s and 40s? Because now people are starting to ask these questions. How can I sort of grow my corpus? How can I build wealth? Where do we begin?
Good afternoon, Sonia. Great to be here. Absolutely. I think SIPs are in news, and I think today we've had the latest figures, and the figures remain robust. So that is great news. Coming to investing in 30s, I think 30s is a great time to begin with serious financial planning. It is also a time which is going to see a lot of life events. So typically, when mamas and aunties start saying, "Ki beta, peace ke ho gaye ho, shaadi karo." So it can be regarding your marriage. It can be if you are already married. It can begin with planning kids. Usually, home is something which is on the radar. And by the time individuals are in their 30s, Sonia, parents are also looking at retirement, and taking care of them can be an additional responsibility. So I think this is a phase where a lot of lovely events are there in one's life, but at the same time, what remains constant is that there will be a substantial increase in the expenses of such individuals. Okay. And the good thing is that these people have already worked for some time, 5 to 6 years, and they're more steady in the careers. I think pays are better. So it's a great time to sort of balance both things so that, your present is taken care of, and you can plan your future in the best possible way.
Okay, I'm glad you brought out this point about the SIPs, right? And I just wanted to put it on our big wall here, the number of SIPs that have gone up over the last many months. And it's helpful to understand. I mean, these are the number of new SIPs. In the month of October, it's almost 20 lakh new SIPs that we've seen compared to about 17 lakh new SIPs in the month of July. So the trajectory has definitely gone up. But even in terms of the quantum, right, the contribution, almost 13,500 crores has come in through the SIP route in the month of November compared to about 12,000 crores in the month of July. So it's really, this is of course just a 5-month chart, but if you map it in the last 2 years or so, it's really grown the amount of contribution through the SIP route. So tell us, Prableen, if I had to start, how does one really plan their finances in the early 30s? If I'm a 30-year-old, I've started, investing in the stock markets, should I just do it via the SIP route? Just start from the very beginning.
I think, Sonia, 3 things are very important for an individual to know. The first is what you earn, what you own, and what you owe. So what are you going to get on a monthly basis? What are you getting? What is it that you actually own, your assets, and what do you owe, the liabilities on you? So I think the beginning has to be probably a boring drill, but opening up Excel and writing down what is it that you're getting on a monthly basis. So you have to have all the cash flows, very nicely. Usually what's coming in is nicely known, but what's going out on a monthly basis is not well known. So you have to start writing down what are your monthly expenses. That's the very basics. Then write down your liabilities. What sort of loans are there on you? Because by the time people are in their 30s, there may be a car loan, they can be credit card overdues as well, maybe a personal loan or an education loan. So making note of all these liabilities is equally important. And then comes, the factor that how much loan can actually one have. So I think when we are doing this math, Sonia, people must understand that, the overall basket of liabilities in terms of what is going out on a monthly basis should be capped at 40% of their salary. So if I'm earning, like, let's say 100 rupee, not more than 40 rupees should be going into repaying of all these liabilities. So that's very crucial. And then you start writing down what exactly do you own. Do you have mutual funds? Probably you were doing employee provident fund, a PPF, just the way, you said SIPs, probably mutual funds are there. And it doesn't, it's not just about writing these, you have to write what is the amount of investment which is there, and then divide it by the total amount of what you actually own. So a lot of people, they worry about, or they are sometimes happy about that. Okay, I'm investing in SIPs, but Sonia, the allocation to that particular asset class, to that particular product, has to be worked out, and that is what will define, how you reach your goals. So the overall allocations have to be known. So income, expenses, liabilities, and what you have, assets.
Okay, in fact, we have a very helpful table that's just flashing on the screen. The investments that you need to make across the board, right? Whether it's EPF, through the PPF route, what your current investment should look like. In fact, it's very helpfully here. If you put a current corpus, right? I mean, we're looking at about 20 lakhs that you can break up between the EPF, PPF, fixed deposit, mutual fund route, how much you need to invest and what the expected returns are. You've taken a 12% average return, Prableen, for mutual funds, which is fair, I guess. And the total return that we're looking at is about 7.5%. Can you just help us, can you run us through this table? We have it on the screen for our viewers, but just tell us, as a 30-year-old, what should my breakup look like? And what is my eventual corpus that I can get, say, at a retirement age of about 55 to 60?
Right. So Sonia, I think, personal precedes finance for a reason. So personal finance is, person to person centric,
Sure.
actually. But this is just a general breakup that if an individual has about, 18.5 lakh rupees and EPF, PPF is there, and about 3.5 lakhs of mutual funds, we are looking at what is the allocation to that particular product in the overall basket. So like EPF is about 24%, mutual funds were around 19%. But again, for each of these, instruments, we've sort of taken the tentative returns that one would be getting, because, mutual funds we're taking at about 12%. If it's an endowment plan, it would be about 5%. Your FDs would be around 6%. And that gives us the return weightage. Because you get to know that what is your overall portfolio return. No investment can be done in isolation. Ultimately, how you reach your goals is based on what your portfolio returns are. And through this breakup, one can know that what is the contribution of which particular instrument or asset class in the portfolio. And this particular breakup that we have, this is a very, very conservative one, because here we are seeing that the overall percentage allocation, the portfolio returns are only working out to be 7.55, and there is a higher allocation towards fixed income products.
So how did you, what is this 20 lakh figure? I mean, is it the contribution that you need to make over a number of years? How much is the monthly contribution that you're looking at?
No, so I think how we begin with Sonia is dependent on, first knowing where do we want to reach. So this is a general breakup, and I think the planning has to start by knowing that what is the requirement for a particular goal in the present date. So let's say as a 32, 33-year-old today, my monthly expenses are about 75,000 rupees. And I'm looking to plan for my retirement. So my retirement, by the time, let's say I want to retire at 55, the same monthly expenses would be about 2.7 lakhs. So first we need to know what is the current expenses that you're doing. If it's a retirement goal, if it's some other goal, then the present value of that particular goal. So then we factor the inflation aspect into it. And once we have a final figure, then we look at which instrument can get us there. So it's like, knowing a destination. And if I have to go to the market, let's say, which is 5 kilometers away, I have to decide whether I want to take my car, I want to jog, I want to run. So I think that would depend on how many years you have, what is your goal, what is the corpus that you're looking to create.
Okay, I want to take this discussion on inflation forward because, that impacts everything, right? The way inflation is going as well. Let's do one thing. Let's take a short break, but don't go anywhere. We'll be discussing all our goals, our retirement focus, children's education. If you're in the age group of 30 to 40, you'd want to stay tuned in for this.